Welcome back to Crypto with Ledger.Wealth.Network, where we break down what's really happening in crypto before the headlines catch up. If you want the signals, not the noise, you're in the right place. Here's a number that should make you sit up straight. Franklin Templeton just said modern portfolios might need 40% crypto allocation. Not 1%, not 5%, 40%. And here's the kicker nobody's talking about. BlackRock's head of retirement solutions just confirmed that 80% of Americans will soon have access to Bitcoin and Ethereum through their 401k plans. But what I'm about to show you goes way beyond just another ETF approval. This is about a complete restructuring of global wealth that's happening right now, and most people are missing the real story. You've probably heard that institutional money is flooding into crypto. Standard narrative, right? Big players are coming, prices go up, we all get rich. But that's not what's actually happening here. What's happening is something economists call a structural shift, where the entire foundation of how money moves changes permanently. And the data I'm seeing suggests we're not just in another bull cycle. We might be witnessing the birth of an entirely new financial system. Most analysts are still thinking in terms of traditional market cycles. 4 years up, then down, rinse and repeat. But here's what they're missing. We've never had sovereign wealth funds from Saudi Arabia to Abu Dhabi building their entire government infrastructure on blockchain. We've never had $1.7 trillion asset managers talking about 40% crypto allocations. And we've never had regulatory clarity coming to the United States with trillions of dollars sitting on the sidelines waiting to deploy. I'm going to prove to you that we're not just seeing another crypto pump. We're seeing the early stages of crypto market capitalization expanding from 3 trillion to potentially 100 trillion over the next decade. And I'll show you exactly why the infrastructure plays. The layer 1 blockchains that will handle this massive flow of value might be the biggest opportunity most people are completely overlooking. Let me start with the retirement revolution that's happening right under everyone's noses. BlackRock's global head of retirement solutions just dropped some fascinating details about what's coming to your 401k. The Department of Labor just established a 6-point process that will allow regular Americans, not just the ultra-wealthy, to access the same alternative investments that pension funds have been using for decades. Here's the key insight. 25% of Americans are in defined benefit plans that already have access to crypto and alternative assets, but 80% are in defined contribution plans, your typical 401k, that have been locked out of these opportunities. Teachers, firefighters, police officers with pension funds have been able to invest in crypto through their retirement accounts. Private sector workers haven't. That's about to change completely. What makes this revolutionary isn't just access, it's scale. We're talking about moving trillions of dollars from traditional 60% stocks, 40% bonds portfolios into something completely different. Franklin Templeton's research shows that crypto native investors don't want the old model. They want portfolios that might look like 40% crypto, then the remaining 60% diversified across public equity, public credit, private credit, and government debt. Think about what that means mathematically. If even 10% of the 401k market, which holds about $7 trillion, allocates 40% to crypto, you're looking at $280 billion of new demand. But the real number could be much higher because we're not just talking about 401ks. We're talking about a fundamental shift in how entire generations think about money. The generational wealth transfer is the secret catalyst nobody's properly calculating. Baby boomers control an estimated $70 trillion in wealth globally. As this transfers to millennials and Gen Z over the next 2 decades, it's not staying in traditional assets. These younger generations are crypto native. They've grown up with digital money, they understand blockchain technology, and they're not interested in earning 2% in a savings account when DeFi protocols are offering significantly higher yields. But here's where it gets really interesting. Franklin Templeton isn't just talking about Bitcoin and Ethereum in portfolios. They're talking about tokenized intellectual property rights, investment exposure to influencer earnings, fractional ownership of art, film, and television projects. Essentially, anything that can generate cash flow can be tokenized and included in a diversified crypto portfolio. This is why I think most people are dramatically underestimating what's about to happen. We're not just seeing institutional adoption of existing crypto assets, we're seeing the creation of entirely new asset classes that can only exist on blockchain infrastructure. Now, let me show you the infrastructure angle that I think represents the biggest opportunity. All of this tokenized value, whether it's traditional ETFs, real estate, intellectual property, or new crypto assets, needs to move somewhere. It needs rails, liquidity, and interoperability between different blockchain networks. This is where Layer 1 blockchains become absolutely critical. As one analyst put it, public Layer 1s will provide the liquidity to move value between private and public blockchains. When BlackRock wants to tokenize their ETFs, when Franklin Templeton creates crypto portfolios for 401K holders, when sovereign wealth funds build government infrastructure on blockchain, all of that activity needs underlying blockchain networks that can handle institutional-grade security and throughput. Here's what most people don't understand about the current market dynamics. We're not in a typical four-year cycle anymore. The business cycle indicators suggest this expansion could extend well into Q2 2026. The GMI Financial Conditions Index has a 9-month lead time, and with the dollar weakening, we're seeing conditions that historically have led to much longer crypto cycles than people expect. Some analysts are comparing this to 2017, others to 2020 and 2021. But I think we're in uncharted territory. We've never had this combination of regulatory clarity, institutional infrastructure, and macroeconomic conditions all aligning at the same time. Tom Lee and other major analysts are predicting significant price appreciation starting in April, but that might just be the beginning. The regulatory environment is the wild card that could break us out of traditional cycle patterns entirely. If the Clarity Act passes, which would provide comprehensive crypto regulation in the United States, we could see the floodgates open for institutional capital that's been waiting on the sidelines. We're talking about pension funds, insurance companies, and endowments that manage literally trillions of dollars, but haven't been able to invest in crypto due to regulatory uncertainty. Let me give you a concrete example of how this infrastructure build-out is happening right now. Stellar's team just revealed their strategy for creating what they call equitable access to the world's financial system. While other projects got distracted by NFTs and meme coins, Stellar focused on building standards and creating a distributed, interoperable on- and off-ramp network. Here's the practical result. You can walk into any of 400,000 MoneyGram locations worldwide and convert USDC in your Stellar wallet into local currency cash. That's not just a cool technical feature. That's the foundation for global financial infrastructure that connects traditional banking with crypto in a way that actually serves real users. This is the kind of infrastructure development that gets overlooked during bull markets, but it's what enables the next phase of growth. When institutions need to move billions of dollars worth of tokenized assets, they need networks that have proven real-world utility, regulatory compliance, and global reach. The privacy component is becoming crucial for institutional adoption too. Major financial institutions like Goldman Sachs and JP Morgan don't want their positions visible on public blockchains where competitors can see their trading strategies. New privacy technologies are solving this problem, allowing institutions to hold positions and execute trades without revealing their strategies to competitors. This institutional privacy requirement is driving development of technologies that maintain the benefits of blockchain, transparency, immutability, settlement speed, while protecting the competitive information that institutions need to keep confidential. Now, here's where the tokenization story gets really compelling. We're already seeing $700 million in total value locked in tokenized equity and ETF platforms, with the entire industry reaching $1 billion. But this is just the beginning. Tokenization solves massive problems for global investors. Many investors worldwide can't access US ETFs through traditional brokerages, or they face high fees and minimum investment requirements. Tokenized ETFs are available 24/7, have instant settlement, and can be accessed by anyone with a crypto wallet. Plus, they create new utility through DeFi integration. You can borrow against your tokenized SPY or Tesla holdings. This is following the same adoption pattern as stablecoins. Stablecoins were the gateway drug to on-chain finance. Once people get comfortable holding USDC in a wallet, they want yield, so they move to tokenized treasuries. From there, they want equity exposure, so they adopt tokenized stocks and ETFs. Each step builds comfort and infrastructure for the next level of adoption. But the real acceleration comes from AI agents. An AI agent can't walk into a bank and open an account, but it can manage a crypto wallet and auto-rebalance portfolios. As AI becomes more sophisticated, crypto infrastructure becomes the natural choice for automated financial management. Let me tie all of this together with the bigger picture. We're seeing sovereign wealth funds across the Middle East, Saudi Arabia, Abu Dhabi, Dubai, Bahrain, Qatar, implementing mandates focused on AI and blockchain. They're not just using Bitcoin as a reserve asset, they're building entire government infrastructure on blockchain, driving licenses, property deeds, voting systems, the complete digital transformation of government services. This represents a fundamentally different adoption pattern than we've seen before. Previous crypto cycles were driven by retail speculation, then institutional hedging. This cycle is being driven by nations implementing blockchain as core infrastructure. That's not speculative money that can leave quickly. That's permanent structural adoption that creates sustained demand for blockchain networks and crypto assets. The mathematical implications are staggering. If we extrapolate current growth rates, crypto market cap could expand from 3 trillion to 100 trillion over the next 5 to 10 years. That's not a prediction. It's a mathematical possibility based on the institutional flows we're already seeing accelerate. Each phase of this growth requires larger players because the market cap is bigger. You don't get to 15 trillion market cap without sovereign wealth funds, pension funds, and asset managers deploying hundreds of billions of dollars. And you don't get to 100 trillion without complete integration of crypto infrastructure into the global financial system. The infrastructure angle is what I find most compelling for long-term wealth building. As this tokenized economy develops, the layer 1 blockchains that provide security, liquidity, and interoperability will capture enormous value, not just from price appreciation, but from actual utility and transaction fees generated by real economic activity. We're also seeing the emergence of specialized blockchain use cases. As one Ethereum proponent noted, general purpose layer 2s might not be enough anymore. Projects need specific advantages, privacy, institutional compliance, focus on particular asset classes, or optimization for specific cases like gaming or meme coins. The projects that carve out clear niches and deliver real utility will thrive, while generic fast chains might struggle to differentiate. The traditional stock market is providing some interesting context too. Tom Lee pointed out that stocks typically bottom within the first 10% of wartime periods when looking at conflicts since 1900. We might be seeing similar dynamics in crypto, where geopolitical uncertainty initially causes selling, but then smart money starts accumulating quality assets. The key insight is maintaining a long-term perspective. Whether you're looking at stocks or crypto, history shows that markets recover from even the worst dips if you can hold through the volatility. The challenge is psychological, not fundamental. Here's my takeaway. We're witnessing the early stages of crypto becoming integrated into the core infrastructure of the global financial system. This isn't another speculative bubble. It's the technological upgrade of money itself. The opportunities ahead are massive, but they require understanding the difference between short-term price movements and long-term structural shifts. The projects building real infrastructure, solving actual problems, and positioning themselves for institutional adoption are setting up for sustained success over the next decade. Focus on the networks that will handle trillions of dollars in tokenized assets. Pay attention to the platforms enabling traditional finance to interact with crypto seamlessly. And remember that we're still in the early stages of the biggest financial transformation in human history. That's the signal emerging from all this institutional noise. The infrastructure for a tokenized economy is being built right now, and the projects that get this right will create generational wealth for their holders. Thanks for watching Crypto with Ledger.Wealth.Network. If this analysis helped you see the bigger picture, hit that like button and let me know in the comments what aspect of this transformation you think is most important. The future of finance is being built right now, and I want to make sure you're positioned for what's coming next.